morning, everybody. Afternoon or evening, whatever time that you're watching this recording. My name is Owen McCafferty, and we are talking about little elements and aspects that exist in our professional fusion partnership model as it would relate to veterinary medicine, dentistry, dermatology, even those groups that would serve the specific professions, such as in veterinary medicine, the veterinary industry, joint partnership. So you can see the flexibility of the conceit is that you're using great people, giving them wonderful opportunity to join together, have the synergy available for utilizing the skills and talents of one another. And the applications are basically as limited as the individual capacity to conceive best utilization. So it's a very holistic model that has plenary applications. One of the things that I'd like to talk about today is the choice of entity structure that we used. There's basically in the United States entity structures for corporations, and they could be classified for tax purposes as either subchapter C corporations or subchapter S corporations for the most part. Then there's obviously individual proprietary entities. When you file a Form 1040 Schedule C in the United States, you would report the results of operations of a proprietorship in that format. So an example of how that would be used is a limited liability company that's a single member would then utilize basically the filing as a proprietorship. You have the protections afforded in each state or commonwealth by the limited liability company statutes, and you have the flexibility of merely filing your own individual income tax return and utilizing Schedule C for proprietorships. And then finally, what we would have would be the partnerships. Now, partnership by its very nature assumes multiple people, multiple entities. The partnership may not necessarily have human beings. They could be trusts, they could be other partnerships. There could be a series of layered partnerships known as disregarded entities. There's many different applications. So what we did was we have looked at each and every one of them. We've employed subchapter S corporations, subchapter C corporations, and proprietorships for our clients. But in the specific application for professional fusion, we believe the utilization of a partnership is most advantageous. One specific reason is ultimately there would be a sale. When there is a sale, assets could then be vended to a purchaser of the practice group or the specific practice if they would choose to break off from the partnership. So maximum flexibility is afforded through the partnership format. Secondly, if you remember, Dr. Tack has alluded to disproportionate distributions. The disproportionate distributions are afforded in a partnership format that would basically be forbidden in a subchapter S pseudo-corporation format where the distributions have to be pro rata. There's more flexibility in a subchapter C corporation as it would relate to disproportionate distributions. But for purposes of maximum flexibility, the partnership format under subchapter K of the Internal Revenue Code, 1986, would be the perceived and preferred choice for professional fusion. In professional fusion, there would be a series of separate partnerships. After assets are poured into the main partnership, let's call it veterinary fusion, or dental fusion, or derm fusion. But each one of those partnerships would then be a master holding partnership for disregarded entities that would be each of the specific identified practices in the locale. As we had indicated before, a practice that exists would be pouring its assets into, in this specific example, the veterinary master partnership. Let's call it veterinary fusion. Veterinary fusion would hold the assets and immediately pour them into a sub-partnership known as a disregarded entity. This disregarded entity would conduct the activities of their own identified locale-based practice, so that items of income and expense, assets, and even liabilities could be identified and attributable to that specific disregarded sub-partnership. It's a simple classification where you basically think of pouring assets into the master partnership, and in a classic sieve, the assets are then poured into a separate sub-partnership for purposes of management of that partnership. There also may be advantageous positions based on specific case law and judicial intent, and finally legislative dictum, as it would relate to each specific state. But the partnership would be a holding partnership. The partnership would be established in a business-friendly state. A business-friendly state, one of the major referrals that I believe is appropriate is taxation. Some states have no income taxation. They would include Florida, Texas, Tennessee, Nevada, Washington State, South Dakota, Wyoming, and Alaska. I may have missed one or two, but those would be the more popular states with no income tax that you'll find corporations attracted to now, but specifically partnerships where we're focused would be attracted. Another advantage is that there would be no income tax at the individual level. So if you had taxable situs, that is, you lived in that state, you worked in that state, there would be no income tax. There's two specific issues relating to, in this case, veterinary fusion. There is the enterprise activity, and that is the activity of the master partnership, let's call it the veterinary fusion. And there's the in situ situs of each individual practice in its location, because each individual practice in its location has to respect state and local laws, one of which is income tax. So you're not entirely eliminating the state and local income tax, but it is allocated and bifurcated between the enterprise that's responsible for the operation and the individual practice that is situated that generates some of the operating income. Going through each one of these elements just to give you a thumbnail sketch of what the construction would be, so that maybe we could strip away some of the confusion. It's a very simple format. The contributing partnership, the contributing practice being a proprietorship, a partnership, a subchapter S corporation, or a subchapter C corporation. That's meaningless, because it's only the assets that are poured into this separate veterinary fusion master partnership, not all of the related liabilities. So the liabilities stay at the contributing practice level, and it's only assets. Our decision in using this format was that there are liabilities that are stated, unstated, and contingent. if we pour in assets net of liabilities, as you would have to do with a merger under Section 368 of the Internal Revenue Code for a corporation, then those liabilities could either be known at the time of the contribution, unknown at the time of the contribution, and discovered later, or could be contingent. That is, they could be probable, possible, or even remote liabilities not known until the time of an occurrence. By bypassing all of that, just contributing assets and letting the contributing entity retain liabilities and deal with those liabilities as they would choose, you eliminate a level of danger that would exist in establishing the partnerships. So it's important to look at all of the aspects, of entity formation. Some people may ask, well, why didn't we choose a state that everyone goes to, and that would be Delaware? Well, Delaware is a state that has a lot of popularity, but the problem that we would choose in Delaware is we would have to have a reason and a logic for why we would choose to place the partnerships there. The operational activity in Florida would be most conducive to the continued operation of the Veterinary Fusion Master Partnership, mainly because it is a business-friendly state. So that's why we chose Florida. Another state that was very much in the contention is where I'm sitting right now, and that is the silver state of Nevada. And we will be looking and assessing, based on tax structure, how Nevada may be an option for the future. Other states that are rather famous because of the fine work of their governor would be a state like South Dakota. We look at not only the issue of what the tax issues would be, but also how easy it would be to transact business. Because one of the things that we wish to do is to optimize the opportunity to mitigate expense and improve EBITDA. So those are just a few of the issues and the reasons and the logics. Dr. Tack and I had discussed the precedent. I promised you that I would provide a detailed explanation. Still, it's rather short. We're under our 15-minute timeline, but I wanted to at least start to address the issue to give you an idea. Seeing things in graph format helps an awful lot. So we'll go through this and through other things, but at this time, I just would like to say, as I always do, thank you for watching. I really do appreciate it. Try to change the venue so you're not always having to look at the same area. But right now I'm in beautiful Henderson, Nevada, which is the biggest suburb of Las Vegas, Nevada, at the prestige-driven and aesthetically uncompromised Green Valley Ranch Resort. Thank you very much.